Residential and commercial loans, and how do you get the right loan for you? That and more today on Cash Flow. Hi, I'm Jason Waters, CEO of JW Financial Group, and welcome to Cash Flow, where we talk about your small business and what your number one goal is to create cash flow. Today I want to address lending. What I mean by lending is residential lending, commercial lending for small businesses. How do they both work? How are they different? How are they the same? And how can you get the loan that you need? So a little bit first, my background is I used to be a commercial banker for 20 years. In that role, I worked with big companies, small companies. It was a lot of financial analysis, a lot of structuring loans, it was a lot of relationship management with clients. When I decided to go out on my own, I broke up what I used to do for clients into multiple things. So I started my CFO level business and I started our residential mortgage team. And so those are the couple things that we do every day to help clients. And so I wanted to take the knowledge that I have from 20 years of experience and from working now and share it with you. So it might help you from your own perspective with the home, or it might help you as a small business when you want to borrow money. So let's talk about what a residential loan is. Obviously, a residential loan is to buy a home, self-explanatory. Commercial loan would be for commercial purpose. That would mean you want to buy a building for commercial purpose building, line of credit for your company, or equipment for your company, or even a loan to buy a company altogether. So when we talk about the similarities are this. The primary source of repayment that every lender's looking at is cash flow. So on a residential loan, that you might hear terms called debt to income, and it's what are your total monthly debt obligations compared to the income you make. That's what it's called on the residential side. On commercial, they call it, you would never know this unless you're a banker, but debt service coverage, and it's the same thing, it's just flipped. How much income, cash flow do I have per month divided by my obligations? That is the basis of both. And then you get into collateral, which is, what is backing up these loans. And then you really get into character, which is, and that's why lenders look at credit scores. Do you have the character to repay loan? And have you done that in the past? Because if you've done it in the past, you're likely to do it in the future. So we talked about the similarities between commercial and residential loans. Let's talk about the differences. Some of the main differences are in terms of rate and structure and term. And what does that mean? So rate. Residential rates are typically lower if you have good credit because the government's buying the mortgages on the market, or government-owned companies are Fannie Mae and Freddie Mac. That drives rates down to I would call it almost an unnaturally low rate. On the other hand, on a commercial loan, a bank is actually loaning the money. So the bank needs to loan money where they can make money, and it depends on how much their cost to operate and how much their deposits are. They're paying for deposits, and so you're going to have a higher rate. You're also going to have different structures on commercial loans. So with a commercial loan, if you're buying a piece of equipment, a bank is going to structure the loan along the expected lifespan of that piece of equipment. So if you're buying something that's going to last 7 years, they're going to match it to be 7 years or less. If you're buying a building, yeah, you could get a longer term, but it's not a 30-year term. Commercial mortgages are not even called mortgages, but commercial loans for buildings, they're going to go probably the most 20 years, sometimes 25, but you don't have 30-year loans on commercial buildings. That's not what the market has. You're used to, I get a 30-year mortgage at 3.75%, and I'm great. Why don't I get this for my commercial? Your commercial is probably more like, I got 5% fixed for 5 years, and then I have to redo my loan on my building. If you're just now getting into buying commercial property, it's one thing to be aware of. Lines of credit, another thing to address for businesses, that's very different. So a consumer line of credit's a credit card most of the time, or a home equity line attached to your house. With a business line of credit, it's usually backed by accounts receivable, it's backed by inventory. There's a percentage that a bank will loan that company on that based on how good your receivables are, how good your inventory is. And so it's a lot different from a structure standpoint. My advice to you in terms of how do you get the best structure, the best loan for your business or for you personally. When I talked about cash flow, name of the show, obviously, that is your number one goal as a business. So you have to be able to show that you're making the money to the bank so you can get your loan. You might be writing a lot of stuff off from a tax perspective, but that's not always going to help you from a bank perspective. So plan in advance with your accountant, with your financial advisor. What is your goal? Where do you need to borrow? And plan for that so that you have enough money to be able to qualify for a loan. From a residential and commercial perspective, always keep good credit scores. I mean, pay your credit cards on time, keep them paid down, keep that as high as possible, because even if you're a small business going for a commercial loan, you're going to sign a personal guarantee. Your credit matters. You're going for a residential loan, your credit score determines what rates you have. So cash flow, credit score, and then of course everybody wants good collateral, but that's what it is there. Well, that's all we have for today. If you have any questions, you can find me on social media at Jason Waters, #cashflow. Until next time.